this is a scenario that is maybe not at all unexpected. It is very sad anytime there are job cuts. But Alphabet is not alone here, and it's almost as if the environment has given many of these tech firms cover to cut jobs because all their peers are doing it. Will you expect more in the coming days and weeks?
Absolutely. The way we look at it is that these companies, these tech companies, made kind of the same mistakes that investors did last year. So when you had this huge pull forward in demand because of COVID, accruing to these tech companies, that growth was extrapolated on a go-forward basis, which is why you had such disappointments in 2022, because they under-earned relative to those expectations that you saw in that accrued in 20 and 21. And I think that the mistake that companies made is the same thing, in the sense that they extrapolated that growth and overhired in anticipation of the persistence of that growth. And in order to normalize back to the original growth curves in not only revenue, but also labor with their respective companies, they had to reduce the labor force. And it's an unfortunate byproduct of COVID, where we're seeing these layoffs happen now. But at the end of the day, this is also what the silver lining is, that it's more of a return to normalcy in terms of estimates as well as headcount growth.
Well, what's crazy about this is, again, it sounds very perverse, but you and I both know it, that oftentimes when companies, tech or otherwise, announce large-scale job cuts to save costs, the stock prices go up because investors cheer it as a cost discipline thing for CEOs in the C-suite. Is this kind of move, are these kinds of moves that we've seen from the likes of Amazon, from Microsoft, from now Alphabet and others, is it enough to make that tech turnaround trade take shape in 2023? Is that the catalyst it needs after a dismal 2022?
Well, I wouldn't say the job cuts are the catalyst, but I think the catalyst is that, our headline for our 2023 outlook piece was that bad news will be bad news again and good news will be good news again. Because as estimates, so what happened was, you had this growth curve expectations, and then when everything was pulled forward, everything came up here. But in order to come back onto the original curve, you had to perform below the curve. And that's what happened with all these tech companies in 2022 with the terrible numbers that you saw. I mean, that's why Netflix, was able to grow 18 million subs in 2021 and only 9 million in 2022. And now that estimates have kind of reset, we're back on that, or nearly back on that original growth curve. So the companies should be able to deliver more upside to estimates than we've seen as of late. And that should help not only drive estimates higher, but also multiples higher from the depressed levels that they're at now. So, we are incrementally bullish every single day on the NASDAQ components, relative to the Dow and S&P.
Now, James, I'm glad you brought up the Netflix trade, because I want you to just hang out here, because those shares right now are up big ahead of the opening bell. Now, this is after adding, as you said, millions of subscribers, more subscribers in the fourth quarter than Wall Street analysts were looking for. Total global paid net subscriber adds, 7.66 million new ads, compared to estimates that were calling for about 4.57 million. So that's a lot. That's a big beat.
Right.
Now, along with its earnings, Netflix announcing its founder, Reed Hastings, is giving up his role as co-CEO, but will stay on as executive chairman. Ted Sarandos will remain the co-CEO of the company alongside Greg Peters now, who was formerly Netflix's chief operating officer and chief of product. He's going to now assume Hastings' co-CEO role. So let's, again, bring this into the discussion, James, about the Netflix story specifically. Is this the right time for Reed Hastings to step away from the day-to-day management of Netflix? And is the subscriber numbers that we saw, are they a bullish indicator for the strategy that Netflix has embarked on with ad-supported tiers and the cracking down on password sharing?
I wouldn't say it's the subscriber growth numbers are a function of the strategy as much as to say that expectations were depressed. Yes, their strategy and their international growth efforts and their international content proliferation continues to impress, and obviously introducing a new ad tier and password crackdown does provide upside risk to estimates. But No, I think at the end of the day, it's scale matters the most. You know, in the eyes of consumers, we view net content as a hub and spoke for consumers, with Netflix being the hub and all the other content providers being the spokes. And the spokes are churnable and cancelable, but the hub is not. You know, so that's kind of our investment case around Netflix. And at the same time, you do have valuation support that you didn't before. And as it relates to the CEO change, I do think it's the right time because, you know, he's been there a very long time. He's the founder, obviously, and we've finally we've cycled through the impact of COVID on the numbers for the most part. So now it's just execution at this point, and I think it's a brilliant move to have the content guy and the operational guy as co-CEOs, because both of them are equally important and tenured at the firm, and both of them understand how much scale advantages matter in this world. And we think it's just going to be increasingly challenging for the competitors out there, and Netflix is in a very good position. And if we can finally say we have valuation support on a stock, which, you know, we didn't have, you know, for as long as I can remember.